Hi, good evening. Today is October 1st, Friday. We had quite a roller coaster week this week and the day as well. I was wrong last week. I was expecting the markets to continue the rally from the week before, but and test the new highs, but we didn't. And this week instead, we sold off starting Monday and continued and had a down week. S&P 500 closed September down 4.8%, roughly 5% down. And it was its first monthly loss since January and the biggest 1 month drop since the start of the COVID rally. But, after 7 months up, as we were discussing before, it's not surprising really to have a down month.
Right.
And the sell-off kind of started with bonds selling off a lot based on the whole debt ceiling nonsense that everybody knows is going to resolve itself. It's just political theater continuing. But then I think it kind of turned into just deleveraging of longs that have been heavily long before, and the deleveraging that kind of spiraled on itself. And the weak longs, as Victor would call them, were finally purged. Plus the dollar also originally spiked in the beginning of the week. So it was this confluence of events that kind of created this negative week in the spiral in the markets.
Right.
But both the dollar and the bonds reversed what they started in a week. But the dollar chart is fairly interesting, as again, we have broken out through the range of almost a year. And whether it continues or not, I don't really know. I think it's probably going to meander in that range, but I'm not really an expert on currency. Andy, what do you think?
It's kind of questionable whether it really fully broke out. I'm not saying, it did break out from this sort of double top here, definitely. But it's like it seemed to reverse right at this level that we had, this mini top that we had back in October. And so I'm not saying it can't power through. If it does, then it really puts the stock market rally in peril, I think.
Right. Well, let's look back at the S&P 500. And today, we had almost a 6% correction since the top, around 6%. Yeah. And what interesting is that the 200-day moving average still wasn't hit. And I wouldn't want today's reversal to reverse or to fail, so to speak, next week, because then I would think if it fails again next week, then we are likely to tag 200-day moving average. So 44.25 is the level that I would be watching to test and see how we act there. But this week, I'm just gonna go with Victor's prediction, who tweeted that we are 20 days from all-time highs, and this was a typical move to scare out weak longs, create margin liquidation, and clear the way to new all-time highs. So that's his call, and I'm gonna hope that he's right. But it's probably not gonna be a very smooth, this rally all the way to all-time highs as we're used to. It could have a little back and forth to jump with the headlines that there should be many next week. The infrastructure bill, the debt ceiling news again, because it's a temporary resolution. And then, of course, there is Powell, who, as everybody knows, just lost 2 of the Fed people there. And he said, which is probably should be bullish because it's very progressive, Powell said that diversity will play a key role in deciding who fills the top job at the Boston and Dallas Feds. So again, they're going to look at diversity instead of qualifications. So the typical progressive agenda. It's also interesting, speaking of the Fed, that the 2 members that we lost to questionable trading leaked were the two most hawkish members of the Fed. So, one could speculate whether this is coincidence or not. I'm going to leave it up to the viewers to see why these two presidents all of a sudden are gone, but it's an interesting coincidence.
Yeah, and yeah, exactly. And they were the dots that were in the wrong place, right?
Right.
So on the dot plot. So yeah, it's the thing that I've been watching is myself is I tend to do things a little bit the way that Victor does or did, which is that you look at, it's not just a matter of like what you think is going to happen. It's kind of looking at the probabilities of different outcomes and trying to put some kind of percent chance or probability on things. And the one thing I've been especially interested in is the probability that we'll at least test this 200-day moving average, which hasn't happened since last June. And that did get up to about a good 30%, 35% in my own models. And it reversed off of that. It's lower now, but still it did creep up. And if we were to break, let's say, this level around 42.50 or so, then it would be a pretty good chance of hitting this. So that's the level that I was really watching as kind of a test of is this just I mean, but still that would still only be a 10% correction. It's not it's anything outside of the ordinary for markets to have 10% correction in the middle of a rally. And so that's something I've been watching on S&P 500.
Right. Well, today was a great example of market deception. Again, we had a huge gap down and almost tested your level, which is also a Soji level. We went down as far as 42.60, 10 points shy of the Soji level, and then reversed sharply and opened at the open sharply higher, yet again sold off right on the open, sold off again to scare anybody who was still long the market, only to rally yet another 80 points. All in all, we had 105 points day from the bottom to the high today, which is pretty an incredible move in the markets. And because I guess nobody wanted to be long, short into the weekend, lots of headline risk, plus after already so many down days, there is a lot of upside risk.
I think there was a tell. And that was the tell for me in watching. I was long a bit VS earlier today, but of course I'm long a lot of crypto too. And it's that this was rallying even as S&P 500 was testing whatever 42.60 and so on. We were seeing a nice rally in Ethereum and Bitcoin, and that started back here on the 30th. So and it had just been chopping around, so it was kind of flat with trading within a range, and then it broke out of that, and even as we were looking really ugly in the early morning and late last night, and so that to me was saying that, well, for whatever reason, these are risk assets. You can say that they're hedges and so on. I'm not really sure I totally buy that myself. I think they're a hybrid. They're mostly a risk asset. And if we had a really severe bear market in equities, then these would go down too, I think. But this was going against it, and it was this was happening before the dollar reversed and so on. So that to me was saying that there's more risk appetite than what the ES was saying at the moment. And so it was, I think that was the tell.
And NASDAQ, I think, had its worst But there was lots of data that came out this week. Consumer confidence dropped below expectations again for the third straight month. And both present and future expectations were down. And also, obviously, various inflation indications. Companies are more likely to pass input costs at the second fastest rate since the data collection began in 2007. And so basically everybody keeps hiking prices, transportation charges. Obviously, everybody heard by now about the gas crisis in Europe. That's the electricity prices are going up. So inflation is going up, not just in US, it's a kind of worldwide phenomena. And well, at least the Fed cares about the diversity. Another one that came out today was that the other day was the housing report showing that we have again the increase, another record in housing prices increase. It's now almost 20% increase year over year. And Zillow index also shows that that finally started percolating into rents. Now rents rose around 11.5% year over year. So the inflation is not transitory. And even Powell himself kind of admitted it, that it's frustrating. And he sees it now running into the next year. So we'll see what appointments Biden or Powell would do for the Fed, but it's not going to be hawkish, most likely, because they want to pass the infrastructure package.
See that all of the hawkishness at this point, in my view, is just it's just talk. There's no actual. There's no. They don't have any bullets, because if they were to raise interest rates significantly, I mean, they can pull off QE or whatever. But if they raised interest rates significantly, it immediately puts the US into a debt crisis, because we can't pay entitlements programs and pay interest on the debt at the same time if the interest rate goes above about 4.5%, 5%. And granted, we're not very close to that right now, but that's nothing compared to what it was in the past. I mean, that was sort of below average for over the past 40, 50 years. So it's amusing. I mean, like they're gonna do anything. I mean, that's not to say it won't hurt the market, but they can't really jack interest rates up very significantly, as they even did in the early 2000s. That was the last time we had them, above, 3-4%, right?
Yeah. And with multiple reports coming in showing that there is a slight slowdown in the economy, which also gives more ammunition for Biden's infrastructure package to pass. So all of that.
If depending on how much of that actually is for infrastructure and not for handouts, different programs, and
Right.
things that will never turn into anything or generate any value.
Right. It will just generate more debt and more spending, which is good for the markets short term, not necessarily good for the country or the economy long term.
Right. I mean, it's like, it's some of these things are really questionable that are in the bill, and that's what the real debate is over that your Manchin and Sinema kind of pushing back a little bit. And it's because that price tag, it's not the number, it's the fact that there's a lot of pork baked into that number. And if we're really an infrastructure bill, it might be like a $300 billion bill or something like that. And
right, but also
that's
zero cost. They will claim we're spending whatever number of trillions, but it costs us zero. It's the new math.
Right. And it in previous both Democratic and Republican administrations, infrastructure would include like oil and gas pipelines, but now that's seemingly forbidden unless you're building it from Ukraine or through the Ukraine from Russia to Germany or something, and then it's okay. But if it's going from Texas to Canada, that's bad. It's these sorts of things that just
Yep.
they really don't make much sense. They could help
Right.
the American economy a lot.
Well, it looks like they're planning to be a great push towards nuclear, because people finally are slowly figuring out, we even talked about it months ago, that if you want some environmentally friendly thing, it's nuclear power. It's not really, obviously, as we could see right now, not the solar and the wind is unsustainable by a long shot. Look at Europe, look at Texas when they had the freeze, look anywhere, California with their blackouts. Nuclear power is that's where we should be focusing on, should have been focusing on for the last decades. So finally it's coming back. So how's the price of uranium should be?
Uranium's been doing pretty well, right? Really well this year. Yeah, it's really the cost leader that is, doesn't have maybe the implications of coal and oil, but at the same time, there's not a single coal power producing plant in the US that doesn't have scrubbers on it and isn't fairly clean at this point. It's more the it's more the PR dimension than anything, more so that the actual impact.
Exactly. Well, let's quickly talk about crypto. You already mentioned that it has been running pretty in advance of ES, and it seems to have a very nice breakout.
Yeah, and to me, the big levels were 3,200 on Ethereum, and on Bitcoin, it was really 46,000. 42,000 was, when it was below that was not great, but the important one was really more like the 46,000 range. And it's sitting right now at, a point where it made this kind of secondary top after, topping out here. But and Ethereum kind of it's a little below that level. So Bitcoin is leading, which
right.
and at the start of these bull moves, it's very typical for it to lead, and that makes sense. If like Ethereum were leading, or some third tier and a coin were to lead, I'd be a little concerned, because it's sort of maybe it's just indicating like some other dynamic happening in the market and not a general bull move. But for Bitcoin to lead, that to me is pretty bullish, and I think this could continue. And the real test will be like around this 53,000 range or level. If it can break through that, well, then that's the sky's the limit in my view. But or at least yeah, it could easily retest this old high. But the point is, I think this is the next real test, is around the 53,000 level, and that's right around the level that makes Bitcoin $1 trillion market cap. So that to me is, I've been saying this, for a year or so, is that it's an important psychological level, that the market cap of 1 trillion seems to be an important psychological level, and it's right at that 52,000, 53,000 level. It changes a little bit from day to day, but that I think it matters to the market for whatever reason. And Ethereum doesn't have that kind of psychological that number. It does, but it's way above where it is, or like a $500 billion market cap. It's in the like the 5,000-6,000 range, somewhere in there. But so I think that the real test for Ethereum is more around like the 4,000 level. That's staying above 4,000 level, sustaining above that level is will be a real test for it. But but Bitcoin, I think it's more. I think there's enough power in this move that it will keep going, and if it can break that, that's great. It'll keep moving, I think. And then they've got the number 3 one is Cardano, which they had their summit this last week or last weekend, I guess, and that made a rally here pretty nicely, and closed some of the loss that is experienced from the high, but it then sold off again, and but it's bounced a little bit. And so I think that in general the crypto market is it's pretty bullish right now. You've got some of these let's say like Ethereum competitors, or they're in the ecosystem. They compete for that smart contract business, like the Fantom, or maybe I wouldn't call, say, Polka a direct competitor, or it is a direct competitor, but it's not in the ecosystem. There's not any kind of portability. But all of these have been rallying really nicely, like Avalanche and so on. They've been rallying nicely. So it leads me to think that this rally could have some legs. But it depends on so this weekend it could be kind of bullish, but then it depends on what the market does on Sunday night and Monday, I think. And that's this was it's been rallying even as the stock market's been going down, but I can't see the rally continuing if there's big downdraft in stocks. But commodities have really been doing pretty well too. I say, like, there have been these kind of quiet rallies in things like corn and like silver's looking pretty bad still, but even there, it's looking pretty bad. But the gold is like trying to find a bottom, but there have been some nice rallies in some commodities, like the ag commodities, and I guess oil is almost broke out today.
Mm-hmm.
So I think maybe the same risk on dynamic that's driving like a crude is what's pushing crypto up at this point. I'm not saying that it's tied to it, but it's just kind of a risk on, sense that it's a good risk environment, regardless of what the stock market's doing. The other thing was that maybe helped a little bit was some, I don't want to say greatly, but it was just maybe it didn't weigh on the market negatively, that like Powell's testimony in front of Congress, he was saying he doesn't want to ban stable coins or Bitcoin or anything. And not that he'd have the power to do that anyway, but just the sense that the Fed is not oppositional. But then there, most people know that are in this, that are serious investors in this space, that the Fed's been meeting with these companies that are behind the stable coins, at least the centralized ones, for 3 years. I mean, they've been meeting regularly with them, trying to understand their product, their risk parameters, and like encouraging them to be more like a bank or a money market fund, that sort of thing. And they've been having discussions for years, and for them to just kind of disingenuously act like they just discovered this thing it's funny, because the Fed knows all about this stuff. I mean, they're very well versed in this. Always some key people are. Right. So it's not like there's it's like something is found out about last week or something. certainly there are people like an Elizabeth Warren who are very opposed to it, but I think they're in the minority of even people in the Senate. And most people, I mean, I think that there will be a move toward more embrace of it, less hostile approach, and that will kind of maybe take some of the risk out of this from the perception of institutional investors. And I'd say, pay attention to some of these key levels in both crypto and then the stock market. We didn't touch on it, but we're just below in the S&P 500. We're just below that
right, the
all
vol
trigger level, which is about 10 points up. And so that what that means is that if it stays below this level, then it doesn't mean that it's going down. It just indicates that there could be more volatility. That is, that volatility would be expected to move up, which could be down, but it could also just be chopping around. Whereas if it makes it back above that level, then it would more likely grind higher with volatility declining. And so that's, I think, one of the things that I'm going to pay close attention to over the next week.
Right. And speaking of volatility, another thing that I was looking at that was kind of helpful to buy today is that the volatility wasn't spiking as much on this move down as
Right.
it has been in previous instances. So that's kind of another interesting thing to look at.
Yeah, it was really quiet. I mean, compared to what we saw in S&P 500, where it was some really wild moves in some of the big stocks, right?
Right, exactly. Yep.
Hmm.
All right. Well, thank you, Andy, and we'll see you all next week.
Okay, thank you.